We are going to start today with a topic called quantitative methods. Now, in quantitative methods, there are 7 chapters. So, in CFA in total, there are 10 subjects. The first subject that we are starting with is quantitative methods. After that, we will do financial statement analysis. After that, we will do the remaining topics like ethics, alternate investments, derivatives, so on and so forth. So first we'll cover quantitative methods, then financial statement analysis. These are the two biggest topics. And then the rest, smaller chapters are there, which we will cover, comparatively smaller. So CFA curriculum, if you start, like we're starting the lecture today, I would strongly suggest whatever I teach, suppose on the particular weekend, that is on Saturday and Sunday, try to cover whatever is taught on Saturday on Sunday morning, and whatever is taught on Sunday in the very next day, and complete the questions of those particular topics before we reach the next class. Okay, what happens is it builds it is like a discipline. If you build it from day one, it builds up pretty smoothly. It is painful, but it builds up pretty smoothly. If you wait for 2-3 months to pass, it gets a bit difficult for you, because then you have to recollect everything. All the lectures are recorded, so you don't need to worry. You will get the recordings. I will share all the notes once the lecture is over. So I'll share it with the VG team. They will share it with you. Apart from that, you have the books and everything, so you can use that. It's up to you, Poco F1.
Yeah.
So that's the overall idea, guys. Sure, you can ask your friend to contact. So coming back to the
Thank
point,
you.
thank you. Let's start with quantitative methods. Today we are going to learn a topic called time value of money. And in this topic, we will understand basically the principles of how money compounds or how money grows. Okay? Am I clear, everyone? So, I keep asking, am I clear? So you have to respond with a yes or a no. It should not be a one-way street where I am talking and you are listening. Okay. Let's make it a bit interactive. Let's make it fun so that you enjoy the subject. It's a very interesting subject. Okay. So, yes or no,
Yes, sir.
everybody?
Yes,
Yes,
sir.
sir.
Great, great. So let's begin. All right. So time value of money. One second. I hope the screen is visible to all of you. I've shared the screen. Can you all see my screen?
Yes, sir.
So if you see this, this is the CFA calculator, everyone. And this is the calculator which you need to use in the exam. So be very thorough with this. Excuse me. I will teach you this calculator as we move ahead. So it will be a step-by-step process. Don't get worried by looking at the calculator. It's very easy. So this is the overall content of the discussion for this particular chapter, which we are going to cover today. So today we will cover time value of money. Since it's an introductory class, and we have already somewhere spent around 45 minutes in the intro discussion. So we'll cover this chapter. I'll give you a 15 minutes break by the time we are done with approximately 2 hours. Okay. So let's begin. First is the introduction, then the interest rates, then future value of a single cash flow. So these are the topics we are going to cover one by one. Let's just straight away start. So we are going to talk about time value of money and interest rate. So guys, what is time value of money? Let's discuss it in a very simple language. Suppose you went to a wedding and your chacha or your mama, whatever, or your uncle gave you 100 rupees or $100. I'm using dollars because you are giving a US based exam. So suppose you got $100 envelope. So if you invest that $100, suppose in a fixed deposit, let's keep it very simple, in a term deposit or in a fixed deposit, where you are earning, suppose, interest of 5% for 5 years. How much did I invest? $100. How much interest will I get every year? 100 into 5%, $5, right? This is the interest I'm going to get every year. Yes or no?
Yes.
Okay. So, uh, so if this is the interest you are getting every single year, then this is called the I by Y, or the interest component. This N stands for the number of periods, and this 100 is called the present value. So see the calculator now. You see this particular portion, the third row, everyone, the third row, N, I by Y, PV, PM, TFV. This is the row which enables us to make these kind of calculations. So we'll learn all of this in a very simplified manner. N stands for the number of periods, I stands for interest rate, PV stands for the money you invested today, and I will discuss FV and PMT as we move ahead. So let's get the basics clear first. What is interest? Now I said 5% interest, but let's understand in a detailed manner what is interest. Many people, honestly, many people don't know the meaning of this. So interest rate can have three different names. Okay, everyone. Interest rate can have three different names. One is the required rate of return. Suppose I invest, I lend money to you. Suppose Prachi wants to borrow 1 lakh rupees, or suppose she wants to borrow $1 million. Let's keep it dollars. I will use numbers in millions, billions, and dollars only, because in exam that is the way they will ask you. So suppose Prachi wants to borrow $1 million, and Prachi has to pay interest on that $1 million. So suppose I am ready to lend that money to Prachi, and I ask her to pay me a minimum 8% interest. So what is my required rate of return in this case? 8%. Because I want an 8% return, only then I will lend money to Prachi. Am I clear? So that is called required rate of return. The return you are looking for, the minimum return that you want. Now, this is the simple meanings. Another meaning is discount rate. What is discount rate? Discount rate is, try to understand this. Suppose this is 900. See this example. You lend $900 when? On day zero. Suppose on 1st January, all of us are standing on the New Year day, 1st January 2023. This is end of the year, this 31st December 2023. So if I am, suppose I say that I want $990 at the end of this year. That means what? How and the Prachi is saying, if you want $990 at the end of 31st December, or at the end of the year, today you need to invest $900. Are you getting me? If Prachi is saying that if you want me to pay, that is, if Prachi has to pay me $990 at the end of the year, today I need to invest with her $900. So that means, what is the interest rate or the discount rate in this case? 90 by 900 into 100, 10%, right? Everybody, yes or no? Please participate. Yes or no, everyone?
Yes, sir.
Yes, sir.
Yes, sir.
Thank you. So, see, CFA is a very, very interesting thing once you get into the groove of it. All numbers and calculations, all this Economic Times newspaper which you read every day, and you're thinking, what does this line actually mean? All that cluster that is in your mind, it will, that cluster will go away. Those clouds will remove from your mind once you are, at least done with your CFA level 1, because you will be able to understand financial jargons. You will be able to understand the math. So these things, as we go deeper and deeper, your understanding will become much better with respect to different aspects, jargons, calculations in finance. So, like when I was doing my CFA program, especially level 1, it was an eye opener, because coming from a commerce background or an accounting background, when you get into finance, you think, oh, I know everything. But it's so humbling and giving you a shock and a realization that no, this finance is totally different from what we think. It's not accounting. So coming back to the point, how did I get this 10%? So 990, which you see over here, is what? The future value. and 900 is the present value. Future value means the money I get at the end of the year. Present value means 900. That is the money I pay today. So 990 minus 900 by 900 gave me my discount rate. Why discount? Because I'm discounting back. See, if I discount back 990, if I divide 990 by 1.1, how much do I get? See the calculator, 990 divide by 1.1. 900, right? So that is why the word discount is used. The word discount is used because we are discounting back 990 and bringing it to 900. The other term or the other word used for interest rate is opportunity cost. This is a very simple example. This happens in our day-to-day life. We just don't notice it. Suppose you get the same example. You get $100 in an envelope in a family function from your uncle. Now you have two options. Either you can spend that $100 in buying a new smartwatch, or you can invest that $100 in a mutual fund or a fixed deposit, whatever. So if you're investing that money in a mutual fund or a fixed deposit, what are you sacrificing? You're sacrificing that smartwatch which you're planning to buy. So that is your opportunity cost. On the contrary, if I'm buying a smartwatch with that particular money and not investing it, then the interest that I've lost of that 5%, 7%, 10%, whatever, on that amount is my opportunity cost. Opportunity cost is the sacrifice that I'm making to get something. Okay, am I clear till here? Yes, no, anything?
Yes.
Yes, sir. Clear.
So now, thank you. So just be responsive, be active, and you will just after a class or two, you will be totally into that zone of understanding the concepts. When you start a new program, it just takes some time to absorb everything. Anyways, coming back to the point, now let's talk about interest rate, guys. Now this is very, very interesting. I mean, this is something which at least I didn't knew when I was starting with CFA level 1, and many people still don't know. Like if you ask someone the meaning of interest rate or the breakup, they will not be able to tell you. A large chunk of the audience will not know this. So there is something called real risk-free interest rate. Let's first decipher what is nominal and real. Forget risk-free for now. See, there is something called nominal. There is something called real rate. So how many of you have heard the word inflation? Mehengai, let's put it that way. Inflation. Cheryl, have you heard the word inflation? Let's put it this way. Starbucks or Cafe Coffee Day. Most of you must have been there for enjoying a coffee with your friends. So if you have been going there for the past 10 years, or just ask your parents what was the price of Coca-Cola when they were of your age, they will give you some abrupt number which you cannot imagine. 2 rupees, 3 rupees, or maybe 50 paise. God knows what number they will come up with. But point is that it will be very cheap as of today, according to you. But the thing is that the value of money has diminished. If 10 years back, I was planning to buy a laptop, I might have to pay 20,000. Today, maybe the same laptop value is 50,000. Has the hardware changed or something? No. The specifications might have improved a bit here and there. iCore 3 has become iCore 5. Sorry?
Due to technology change.
Yeah, but also due to the rise in cost of inputs. The salary of a person, suppose a person was earning 5 lakh rupees 10 years back. Today, if he still continues to earn 5 lakhs, his real value of money has diminished. Because 5 lakh rupees 10 years back had more value than 5 lakh rupees today. Because you are buying stuff today which are priced higher compared to what they were priced 10 years back. If I was buying a cup of coffee from CCD worth 100 rupees, today that same cup of cold coffee might cost 250 rupees or dollars, whatever. Point is that nothing has changed. It's the same cup with that same 50 ml, 100 ml coffee with the same person offering it to me in a similar size store. So why has the price gone up? The price has gone up because the price of coffee beans has gone up. The salary of the staff has gone up. The rent has gone up. The cost of the packaging has gone up. The electricity costs have gone up. All these reasons have led to the rise in price. This is called inflation. This is what kills an economy. If you look at the current scenario, for example, in Pakistan, I'm not trying to demean any country here. I'm just trying to give you a perspective. Today, $1, if I want to buy $1, I need to pay somewhere around 220 or 230 Pakistani rupees, which was 120 or 150 not a long time back. Maybe in the last 3-4 years only this has happened. In India also, if you see, we have to pay 82 rupees to buy $1. Why is this? Why is there a constant rise? 1 second, I see a query. Yes, Kirat. So you are absolutely right that see, your friend is giving a very good example of samosas, that in 1 rupee, their parents used to get 4 samosas, and now it is for a single piece, they are paying 10 rupees. So point is that all this is the meaning of inflation. So coming back to interest rates, when I am saying that I'm investing my money, suppose I'm investing my money with a bank, suppose HDFC Bank. So let's take the best example. Currently, Kotak Mahindra Bank, if you do a fixed deposit in Kotak Mahindra Bank for a period of 23 months, this is actual data, okay? If you do an FD in Kotak Mahindra Bank today for a period of 23 months or less, somewhere around 2 years, let's keep it simple, you will get an interest rate of 7%. Okay, 7% is the interest rate. What is this 7%? This is the nominal rate. Why? My total return is 7%. But inflation in India is in the range of 5 to 6%. Let's assume it to be 5%. Let's assume it to be 5%. That means every year when my money is growing, 5% of that is nothing but covering for inflation, because the costs are also growing. So suppose I'm planning for my child's education. So I recently had a daughter. So suppose I invest this money in the name of my daughter. So after 20 years, when I plan to withdraw the money, if inflation, let's say inflation is 5% and it stays that way for the next 20 years, that means what? My investment of 7% returns was beating the rise in cost by how much? 2%. Because 5% was also the rise in the cost of education. If today it is 20 lakhs, after 20 years, it would have increased by 5%. You can calculate that. I will teach you how to do that. So technically, what is the extra or the real rate of return? That is 2%. That is called real rate of return. Real is the actual return. Inflation, above inflation, how much am I earning? So if nominal is 7%, inflation is 5%, then real return is 7% minus 5%, 2%. Are you getting me? Am I clear with this, everyone? Just focus on this part right
So
now.
this is called, 2% is called real risk-free interest rate.
I will come to that. This is the real rate. For now, let's
Acha,
just
this is
remember
the
this is the real, actual returns. Okay.
Okay.
So this is why is this called risk-free? See, the 7% example which I took was of a bank. Okay. So let's just assume that in a fixed deposit, we all know that there is no risk, right? That is a mindset we have. FD has no risk. But suppose I don't lend money to Kotak Mahindra Bank. I lend money to Adani. Now, I know that is a very bad example because currently Adani stock price are just going towards the floor and the news is not good. So that is why it's a good example. Suppose you're lending it to any corporate, Ambani, Adani, ITC, choose your company. So now these corporates are end of the day companies, they are not banks, right? I'm not saying banks are not companies. It is just that banks are into the business of lending, and a highly reputable bank generally has low risk. So if I'm lending money to a corporate, a company which is into the business of oil or textile, whatever, so technically there is some risk which is associated to that company. So that risk-free element goes away. Basically, when I'm lending to Ambani or Adani, if my FD rates are suppose 7%, so 5% is the real, 5%, 2% is the real risk-free rate. 5% is the inflation. So the rise in price of goods and services, real returns. This 7% total is what? Risk-free. Why? Because I am lending it to, suppose, government of India. Let's keep it this way. We are lending it to government of India. Government of India is risk free, right? So if you're lending it to government of India, suppose government of India is giving us 7%. So 5% is inflation, 2% is real risk-free rate of return. So what is the rest which is being added here? Default, liquidity, maturity. Let's understand this one by one. Now, suppose instead of lending to government of India, I plan to lend this money to Adani or Ambani, whatever. So then when I'm lending this money to them, they are end of the day not the government of India. So they are corporates. Their businesses can fail. Their businesses can go through a rough time. Their businesses are not as reliable as the government. That is quite obvious. It's a no-brainer. So there is a default risk. Default risk means, what if the company fails? What if tomorrow Adani fails? And it's something like that is happening right now. There is a very negative news running around Adani, a very respectable, research firm. I think Hedinburgh or Henenberg something, who are into short selling, have released a report that Adani is in a bad shape, and all that data is shared of excessive lending, pledging of shares by the promoter, all that. So basically, their default risk has gone up. So if today Adani comes out with a bond and say that we want to borrow money, people like us who are going to lend them will say, boss, you are very risky. I will not lend you at 7%. I want 10%. So that extra 3% that you are charging is called default risk premium. You are charging higher rates because you are expecting that company is risky. So if I'm taking a risk with you, I want higher returns. So that is called default risk. If the risk is very low, suppose it's Mukesh Ambani company, very low risk for now, company is in a very good shape. So the default risk will be low. So you will lend money to Ambani at 8%, but lend the same money to Adani at 10%. Am I clear, everyone?
Yes, sir.
Any questions still here, anyone? Hello. So I'm talking about Ambani, Adani. Where is everyone? Check. Don't go and check their share price now. Manmeet, Dilpreet, all okay, guys? Where is everyone? Can you all hear
Yes,
me?
sir, clear.
Yes,
Clear?
sir.
Yes, sir.
Clear.
Thank you. Thank you for the response. So coming back to the point, now liquidity. Liquidity is simple, guys. Suppose I borrow money from you for 1 year, but I don't pay you in 1 year period. I pay you in 2 years. It's not like I defaulted. I just delayed the payment. So suppose your company is a infrastructure company, okay? And usually infrastructure companies have long-term projects which run for 5 years, 6 years, maybe 10 years. There can be some projects which are short period, or technically usually there are longer periods. So there, if the project gets delayed, your payment might not be made in 5 years. Suppose you're not able to complete that road between Bombay to Pune or Bombay to Delhi, as asked by Mr. Nitin Gadkari, in 5 years. You complete it in 8 years. So they will not pay you. They will pay you in 8 years. So the bond which you had issued to borrow money and promised the bond bearer that you will pay him in 5 years, you paid him later. So there is a liquidity risk involved. So when they issue a bond, they factor in a premium for liquidity risk. Suppose you charge 1% extra for liquidity risk. So the more riskier companies, like if you talk about ITC, ITC has a very strong cash flow from operations, somewhere around 14,000-15,000 crores. That much cash is there with them, ready. So if ITC comes out with a bond or something, and they want to borrow money, their liquidity risk is negligible. So they might not pay you a premium for liquidity risk, or you might not be able to charge that to them, because they will say, boss, we have money ready with us. We can pay it whenever we want. Third is maturity premium. See, think about a very simple example. You have two options. Option A is you are lending money to someone for 1 year. Option B is you are lending the same amount of money to me for 10 years. Which is more riskier, 1 year or 10 year? Anyone?
Sir, 10-year is more risky.
10 years is
10.
more risky.
Why? Why do you think so? You are correct. Why do you think so?
Sir, if we are invested this money in equity fund, so in equity fund, there is more risk. Better.
See, you are right, because this comes intuitively. See, the longer the period you lend, the risk is more. Why? What happens in 10 years, I don't know. What happens in 1 year also, I don't know. But see, if I'm lending money to Reliance for 1 year, I know in 1 year, not major changes can happen in the company.
Or depletion, we don't know.
Yeah, but in 10 years period, what if there is a dispute just like earlier Ambani's had between two brothers? Again, Akash and Anand Ambani start fighting and the company goes in a doldrum or something like that. Then my value of the company will be at risk. Stock value will be at risk. Company's position might get unstable, and risk might go up. So I will charge a higher rate of interest for longer periods compared to shorter periods. So that is why maturity premium. If it's for a short-term period, maturity premium will be less. If it's for a long-term period, maturity premium will be more. Exactly, uncertainty goes up.
Sir,
Yeah.
sir, I have one doubt कि default और maturity में क्या मतलब फिर difference क्या हुआ?
Default means reputation of the company. How has he performed in the past? How is the position of the company? See, if a company has a lot of debts already piled up in the books, that means what? If the company is borrowing more, there is a high chance of default. So if you want to lend that company, you will say, boss, you are very risky. I will lend you, but I want higher returns. Maturity is the company is okay, but the company is borrowing for 10 years. And there is another company who's borrowing for 1 year. So because the company is borrowing for 10 years, and in 10 years, anything can happen. The risk is more for a longer period. So I charge him for maturity. Am I
Okay,
clear?
sir, got it. Thank you.
Got it.
Sir, can you please again explain the difference between liquidity and maturity premium?
Liquidity means, suppose you are lending money to Larsen and Toubro. Larsen and Toubro is into infrastructure, road, bridges, rails, whatever. Now, when Larsen and Toubro is into infrastructure, they are usually going for longer term projects. Suppose 5 years they are planning to build a road from maybe West Bengal to Uttar Pradesh. Now, these payments are based on what? Percentage of work done. You complete 30% of the roads, inspection will be done, payment will be made. So on and so forth, right? If you take any infra project, that is the way it goes. Now, Larsen and Toubro, when they initiated the project, they got the tender approved from the government. So on the basis of that project, they did a project financing. That is, they issued a bond in the market, said, boss, we are coming up with this project work. This should be done in 5 years' time. And we are borrowing money for this. Now, obviously, they are saying that it is expected that it will be done in 5 years, but it may take 5 years, 6 months. It may take 6 years, it may take 7 years. So depending upon the company's reputation, their past track record of how they have done in the past, delivered the projects in the past, a liquidity premium is factored in the bond. So if you have a very good track record, you will have a very low liquidity premium. If you have a poor track record, you have always delayed your projects and paid on a later dates to your lenders, then there will be a higher liquidity premium. Or if suppose you are a new company, nobody knows about you, then there will be a higher liquidity premium. Am I clear?
Yes.
Yes.
So Jill Smith, if you see this question, wishes to compute the required rate of return, which is the least likely. So we have studied inflation premium, we have studied maturity premium. There is nothing called nominal premium. There is no such word called nominal premium. So this is the least accurate. Again, this is another simple question. Which of the following is least likely true? So what is written in point number 3? Required rate of return is the maximum rate of return an investor must receive. It's not maximum. It is the minimum.
Minimum. Yes.
So option C is so they asked least likely true. So option C is the option. Okay. Am I clear, everyone?
Yes, sir.
Yes.
Yes, sir.
Now have a look at this interesting example. So first question, explain the difference between interest rates on investment A and investment B. Why is there a difference of 0.5%? If you see 0.5% between A and B. Let's check first maturity. Maturity is the same. So there is no gap because of that. Default, both is low. So that is also same. Liquidity. Here liquidity is high. Here it is low. So B has a lower liquidity. So B is paying 0.5% extra as what?
Extra. Yes.
Liquidity premium. So that means what? In the market, liquidity premium is how much? 0.5%, right?
More.
Yeah. If anyone has liquidity issues, they will pay you 5.5% extra. Am I clear?
Yes, sir.
Yes.
Question 2, estimate the default risk premium. Now try to understand this. Let's look at D and E. Let's look at D and E. So let's understand this. D and E both have maturity same, right? So let's write D as D hash. For now, let's write D as D hash. Okay. So here it is written liquidity is high. Let's cut this. Let's make this low. Okay. So that means what? If this is low, I will make this plus 0.5%.
Hmm.
Everyone, be with me. Okay. Just be with me. Just listen to this carefully. It was
It's
written D
3.15.
had a high liquidity. I am saying, let's suppose it's not high, it's low. That means what? What should be the interest rate? If liquidity is low, default risk is low, and maturity is the same in both the cases. 3% plus 0.5%. I have just added how much? The liquidity premium. Everybody, am I clear?
Yes, sir.
What about others? Is only one person clear with this concept?
Yes, sir.
Yes, sir.
Okay, great. So E, let's look at E now. E has a low liquidity. Default risk is high. Here default risk was low. So what's the
Low.
difference between D and E? Both have low liquidity. Both have maturity. So see this here, since it's low, this 0.5% was already included in this. Okay. Since it is written low here, it has been assumed that this 0.5% is included. Because here also, if you see, this was 2 and this was 2.5. So why was this 0.5 extra? Because of liquidity risk, right?
Yes, sir.
But what is the question asking us? Default risk premium.
This
So here it is, both of them are low. Here maturity is same. So if here default risk is low and here it is high, what is the difference between these two? 4 minus 3.5%,
plus 3.5%.
0.5%. This is what? Default risk premium. Are you getting me? Everyone,
Yes.
Yes, sir.
am I clear? Any questions? Hello, everyone. Any questions?
No, sir.
What about others? Guys, please feel free to ask any questions if you have.
सर ये
प्राची।
क्वेश्चन में डी और ई के बीच में निकालना था.
No, see, try to understand. If I had to find these numbers, first, what did I do? I found my liquidity risk premium, because here, if you notice, maturity was same, default was same, liquidity was different. Okay. So what I did was, since this was the only reason of difference, I found my liquidity risk premium. Now, once I found my liquidity risk premium, next, what do I need to find? What is the question asking? Estimate the default risk premium. In first question, what was the question? Estimate the difference between interest rates on A and B. So the difference between interest rates on A and B is 0.5. But why is that 0.5? Due to liquidity. Now, when I know my liquidity risk premium, next question is asking me what? Find the default risk premium. When I check D and E, I notice that there is a difference in liquidity. There is a difference in default also. But I just want to know the default component. How will I know that? Simply, I added the liquidity premium here by considering this as low. So that means what? The difference between the two, whatever is left, is default risk, because maturity is the same. Are you getting me?
Yes, sir.
You could have used any different combination. I used this combination because it was the fastest, or this is what I observed. Am I clear?
Okay,
Kirat?
okay, sir.
Yes.
It's not like you have to use this combination only. It is just that this is a very easy way to do it. The first question only helped me in finding liquidity risk. So why should I waste my time in trying different combinations? Okay. Am I good till here? Naman, Prachi, Kirat?
Sir, I have a question.
Yes, sir.
Yeah.
So in the A investment, liquidity shows high, but then why is the interest rate low?
Yeah, because
Like
high liquidity means what? They have more money to pay you. They can easily pay you off. High liquidity is positive sign. Low liquidity, I'm saying you have low liquidity. That means you have less money in the bank. I say you have high liquidity. That means you have more money in the bank. Or you have easy access to capital.
Okay, sir, got it. Thank you, sir.
Manmeet, all good?
Yes, sir.
All right, guys, just, enjoy the session, feel relaxed, don't feel nervous. Should I ask the question? Should I not ask the question? It looks like a stupid question. It looks like a weird question. Question is a question. There is nothing called stupid, weird. basic, advanced. No such thing like that. Feel free to ask whatever you want to ask. So coming back to the point, calculate the upper and lower limits for interest rates on investment C. So if you see over here, R is written, interest rate is not given. They just want to know the range for this particular investment, company C. If you notice here, in this company C, what is written? Liquidity is low, default risk is low, maturity is 2 years, right? If maturity is 2 years, that means what? It is between year 1 and year 3, right? So it is between A, B and C, D. Everybody? Yes, no?
Yes.
Yes, sir.
So C has a maturity. So C has more maturity than B. Let's assume B. So if you notice, C and B have only difference in maturity. Okay. C and B have only difference in maturity because liquidity is low in both the cases. Default is low in both the cases. That means what? C will have a higher rate than 2.5. Everyone, are you getting me?
Yes. Yes,
Yes,
sir.
sir.
Whereas if I compare C with D hash, not D, D hash, where this is low. So both liquidity is low, default risk is low. But here D has a higher maturity than C. That means what?
C.
C will have a lower rate than
Low.
3.5. So the range will be 2.5 to 3.5. More than 2.5, but less than 3.5. Getting it?
Yes.
Am I clear? Everyone? Yes, no?
Yes, sir. Yes.
Yes, sir.
Okay. So what is the future value of a single cash flow? See, try to understand. You must have studied this formula sometime in class 8 or 9, and you might have forgotten it. Usually, people, once they study a lot of advanced trigonometry and mensuration, they just forget everything. So it's fine. Future value. This is the most basic formula in maths which you have studied in class 8, 9, 10, whatever. Future value is the value in the future. That is, say, after 1 year, 2 year, 3 year. Present value is the value of the money today. Today. R stands for interest.
Rate of interest.
Correct. N stands for number of
Number of
periods, not years, periods.
Okay,
There's a
periods.
difference. I will tell you. So if I'm saying today I have $100 in my pocket, interest rate is 10%. What is the value of this 100 after 1 year? What will you say? 100 into 1.1, 110, right? Everyone? Yes, no, anything?
Yes, sir.
How much does 100 become after 1 year? Can you answer this? 100 becomes 110. Yes, no, anything, guys? All clear?
110.
Simple maths.
Yes.
What about others? Why is only Prachi saying yes?
Yes, sir. Yes.
Sir.
So there is no shame in saying a no. It's just that you need to respond. Dilpreet, all good?
Yes, sir.
So 100 becomes 110. Now 110 is reinvested at 10%. You don't take this money home. You put it the entire 110 again. So this becomes what? 110
1 to
into
1.
1.1? 121, right?
Yes.
And it goes on like this. And it
Yes.
keeps going on like this. Okay. Now, what is this called? Compound interest. Remember this word, or have you all forgotten?
Yes, sir.
Money keeps rolling. Money keeps rolling. You are not withdrawing money. Money keeps rolling. 100 becomes 110. Then you put that 110 into the basket. That grows to 121, which grows further. So it keeps growing. It's not like the same 100 is growing. The money, the interest is also reinvested. This is called compound interest. Interest on interest, basically. But you remember something called simple interest?
Yes, sir.
Yes.
Suppose you do a
Yes,
fixed
sir.
deposit where you select an option, yearly payout. That means every year bank will give money. Suppose bank will send you a check of $10. So that means what? 100 is there in the bank. At the end of the year, it is also 100. Next year also, it is 100. Another year also, it is 100. Why? Because every year you are getting a payout of fixed money 10. So that means your interest rate is 10%. Your payout is fixed. The 100 did not become 121 or 133, whatever. It was 110 each year because you were paid 10. You were not putting the 10 back into the business. Am I clear, everyone?
Yes.
What about others? Dilpreet, Kirat Singh,
Yes, sir.
Cheryl.
Yes, sir.
Cheryl, are we good till here?
Yes, sir. Yes, sir.
Okay. Just give me a second. Okay. So have a look at this question. A very simple question. Cynthia Rogers deposits $5 million in the savings account. You have a savings account in HDFC Bank or Axis or whatever. You deposit $5 million into that bank. Your bank says, I'll pay you 5% interest. If after 2.5 years, Cynthia withdraws the money, how much will she get? So what is the future value basically? Future value is nothing but 5 million into 1.05 to the power 2.5. Everyone, the formula which we discussed, future
Yes,
value is
sir.
nothing but present value into
And
1 plus,
value.
sorry,
Nothing.
okay. Am I clear till here? This comes to 5.649. See, second. So this is your calculator. So do you have the CFA calculators with you, everyone?
So which one are you using? Is it the BA2?
Yes, this is the BA2. Everyone, do you have the CFA calculators?
No,
No,
sir.
sir.
No
Not now.
problem. I would suggest you buy it from Amazon or from wherever you want to buy. I think the easiest way to buy is from Amazon, and keep it handy from the upcoming classes. You can. I know you will not get it tomorrow. It's totally fine. Just look on the screen, and you will understand. Or you can download this app. 1 second. I'm forgetting the name. BlueStacks. BlueStacks 5, but you will need the calculator in the exam. So you can, for the temporarily, you can download an app called BlueStacks 5. You just Google BlueStacks 5 and download that app in your system. You will get the BA2 Plus over there in case you want it immediately. Otherwise, just order it from Amazon and by the next weekend classes, you will get it.
So BA2 or BA2 plus?
Plus. There is only one BA2 Plus.
Okay, sir.
Texas Instrument BA2 Plus. There is a calculator of I think 2,500 or 3,000 rupees or something. I don't know what is the exact price. Somewhere in this range. You can order it from Amazon or anywhere. So have a look on the calculator. Have a look on the screen. See, in this calculator there is a button called second. So you press this second button. Then you press this button FV. Why am I pressing this? Please try to understand. Why am I pressing second? If you notice, above these buttons, above N, above I by Y, above PV, above PMT, above FV, there is something written in yellow. What is written above FV? Clear TVM. What is TVM? Time value of money. So when I press second, I am basically trying to press clear TVM, not FV. FV is the first button. This, if I press second and then I press FV, it becomes clear TVM. So I am clearing all the past data in the calculator. Second, clear TVM, and here I press clear work. Second, clear TVM, second, clear work. What happens is any past data that is there in the calculator, which can impact my calculation, it will automatically be erased. You need to do this every time when you do a fresh calculation. Okay, so just remember this. Now, if you see, there are 4 zeros after this decimal, right? Everyone on the screen, this is calculator stuff. You need to listen to this. You see 4 decimal places over here, right? So if I want to make this 5, how will I do it? I will press second. I will press format. Do you see this? DEC, this stands for decimal. How did I do it? I press second and the button at the bottom. Here you see format is written. Format. So now suppose I want 7 decimal places. So I press 7 and then I press this enter. Okay. Now clear. See, now there are 7 decimals or 7 zeros after the decimal. Am I clear, everyone?
Yes, sir.
Anybody who is not clear with this? Hello. Yes, no, anything.
Yes, sir. Clear.
Yes, sir, clear.
Okay. So see this. We know what. What are we asked? What do we want to calculate? Future value, right? This is the number we want to calculate. We don't know. But what do we know? What is the value today, guys? Please tell me how much are you investing today? 5 million, right?
Yes,
I'm
sir.
investing 5 million. So 5 million, if I'm investing today, that means what? That money is going out of my pocket. The money is going out of my pocket to Axis Bank. So I'll press plus minus. This will make this negative. Plus minus sign is nothing but if I want to make a positive sign negative, I'll press this. If I want to make a negative sign positive, I'll press this again. Okay, am I clear? Since 5 million is going out of my pocket today, and I'll press PV. I am putting -5 and then I press present value. So I've entered that present value or the money I've invested today is 5 million. For how many years? 2.5, 2.5. What is N is what? Number of years? So N. What is the interest rate? 5%, right? So 5 I by Y. Am I clear, everyone, till here? Am I clear till here, everyone?
Yes, sir.
Sir.
So for
Now,
5 million, you're just taking 5 in the
sorry?
calculator. For 5 million, you're just taking the number 5
Yeah,
in the
yeah.
calculator.
See, the answer is given in 5.649 million. So if it comes to 5.649, I will select that. Are
Okay.
you getting me? The answer is in 3 decimal places, right?
Yes.
So see this. What is PMT? PMT means, is there any regular payment that is in 2.5 years? Is there any payment coming, say, at the end of every 6 months, at the end of every year? No such thing, right? So PMT is 0. Now what? Compute FV. See, 5.6486. That is 5.649. It's rounded off. So my future value is 5.649 million. Am I clear?
Yes.
Anybody, any questions in this part? Hello?
Sir, can you repeat again?
Yeah. So let me clear it. So let's clear the calculator first. Second, clear TVM. Second, clear work. We have cleared all the data. What is the question asking? What is the future value? How much is the money I'm getting after 5 years? Okay. Sorry, 2.5 years. How much am I investing today? 5 million, right? So 5
5 million.
million. I'm just taking the million in million. So plus minus 5, present value, right? I'm investing 5 million, so -5 because it's going out of my pocket. Outflow. For how many years? 2.5. So N. What is the interest rate? 5%. Okay. Interest rate is how much? 5%.
And
Is there any
5%.
periodic payments in the middle? No.
No.
0. PMT. Compute FV. Getting
Okay.
it?
Yes, sir.
If you do this calculation, you'll get the same answer. But in exam or in your personal life also, don't waste your time on these formulas. This is given for explaining the logic. In exam, don't even think about using this. Only calculator. You will be very, very comfortable with the calculator once you have spent some time in practicing. So all this will be at the back of your hand. You don't even need to memorize anything. So see this calculation. Everything is given. This is an example. Basically, they are saying that present value is 100, interest rate is 10%, number of years is 5, PMT is 0. Calculate the future value. See, future value is coming negative. Why? Because I did not put a negative sign in present value. Am I clear? Suppose you have borrowed 100 today. So how much do you need to repay? You need to repay 161. That is why it is coming to negative. Everyone, am I clear?
Yes.
Yes, sir.
Yes, sir.
So this is a step-by-step approach written on the screen for you. This is given in my notes. Any doubts, guys? Anyone? Any questions? Dilpreet, Manmeet, Kirat,
No,
Prachi,
sir. All clear.
Clear, sir.
Naman, Cheryl.
All clear, sir.
What about you, Cheryl? Any questions?
So I was just thinking like this was for compounded annually. What if it was semi-annually?
I'll
Would
teach
they-
you. I'll teach you.
Okay, sir.
But did you understand this?
Yes, I understood this.
Yeah. Don't worry. It's good you are thinking in that direction. So your question will be answered here. You invest 80,000 in a 3-year certificate of deposit. The certificate of deposit offers a stated interest rate of 10% compounded quarterly. How many quarters are there in a year? 4, right?
4.
3 months is 1 quarter. So 4 quarters are there in a year. Now, how much will you have at the end of these 3 years? So see, try to understand. Earlier, we took the most simple example. You are investing money. You are investing money for 3 years. You are getting paid at the end of each year. Or you are earning interest on an annual basis. Okay. Now I'm saying that no, you are earning interest quarterly. That is, in every 3 months, you get the interest which gets invested back into your portfolio or in your pool. Okay. So 0, 1, 2, 3, 4, 5, 6, 7, 8, 9. So 3 years, how many quarters are there? 12 quarters. 10, 11, 12. Okay. This is year 1. This is year 2. This is year 3. 4 quarters, 4 quarters, 4 quarters. So that means for how many periods you are earning interest? You are earning an interest for 12 periods, right? Each year, 4 quarters. So 4 quarters into 3 years is how much? 12 periods. Everyone, am I clear? Yes, no, anything, guys?
Yes, sir.
Yes, sir.
Are we good till here, everyone? Any questions? So if n, which is number of periods, is 12. Now, see, everyone, look on the screen and listen to me carefully. What is the interest written? 10%, right? But guys, try to understand. Does this mean 10% in every quarter? No, right? If 10% in every quarter will become 40% in the year or even more. I am getting 10% interest per annum compounded quarterly. That means what is the quarterly interest rate? I by y is equals to 10% divided by 4, right? Everyone, are you getting this? Yes,
Yes.
no, anything?
Yes, sir.
Yes, sir.
Yes.
So 2.5% is the interest you are earning in every 3 months. Because I am converting this into number of quarters, I also need to adjust this for quarters. So I know my n, I know my I by y. What is the PV? 80,000. So minus 80,000. Why minus? I'm investing this money, right? It's an outflow. Compute what? FV. Okay. PMT is 0. There is but nowhere it is said you are getting some cash in your account in every 6 months, 1 year, 3 months, whatever. So PMT is 0. Any periodic payments are not coming. Just you invest 80 and you get some money after 2.5 years, after 12 periods or 3 years. How much is that money we need to find? So now come to the calculator. Look at the screen, guys. Now, first clear the data. Second, clear TVM. Second, clear work. Okay. Second, clear TVM. Second, clear work. So let's enter N first. N is what? 12. What is I by Y? 2.5. Everybody, now you should understand this. What is 80,000? Please tell me. Present value, right?
PV.
0 PMT. So basically, compute FV. Technically, you will get how much? 107,591. This is the future value that you will get. Okay. Am I clear, everyone? Any questions?
Yes, sir.
What about others?
So
Clear,
I
sir.
by
Clear,
Y
sir.
has to always be manually calculated and then inserted into
Yes,
this.
yes. If it is quarter or semi-annual, suppose it was semi-annual, that is in every 6 months, then 10% divided by 2, 5%. And number of periods will be not 3 years, it will be 6 periods, not 12. Are you getting it?
Yes,
Yes.
sir.
So you just calculate it manually and then put it. Okay.
So is there a set way of putting these indicators into the calculator? Like first has to be PV or
No.
second?
You just need to finally press compute and press the button which you want to calculate. Out of these 5 datas, which is here in the third row, 4 numbers will always be given. If nothing is mentioned in PMT, take it as 0.
Okay,
But
sir,
make
thank you.
sure that you insert 0 in PMT. Don't skip it. Okay.
Yes, sir.
Everyone, am I clear?
Yes, sir.
What about you, Manpreet? Manmeet, sorry.
Sir, clear.
Kirat,
Clear, sir.
Naman, any questions?
No, sir. Clear.
Prachi and Cheryl?
Sir, cleared.
Clear, sir.
Okay. So, thank you. Thank you very much for being so patient. We have done this. This is the same sum, so I'm not discussing it. Now have a look at this, guys. Have a look at this, everyone. Now someone has to tell me. It's not a one-way street. I will read the question. You tell me what will be the data. So Donald invested 3 million in a bank that promises to pay 4% compounded daily. Compounded daily. How many days in a year? See, they have written 365 days. We all know this, but in exam, they are very clear with everything. Sometimes they write 360. Sometimes they write 365. So whatever they write, please assume that to be the number of days. And if nothing is written, take it 365. So N, I have already told you 365 now, right? So one thing I have shared with you. What are they asking? How much money you will receive? When? At the end of first year. At the end of that particular year, how much money you will receive? So tell me the I by Y. One person will tell me I by Y. One person will tell me PV. And FV I will calculate since you don't have the calculator. Tell me, everyone. Someone volunteer and tell me I by Y. Anybody? I just taught you how to calculate I by Y. Interest
Sir, I
divided
by
by...
Y will be 4 by 365.
Very good. I by Y will be, thank you, Manmeet, 4% by 365 days. Whatever the number is. Now, what is the present value?
Minus 3
3
million.
million.
Minus 3 million.
Minus
Correct.
3.
Future value we need to calculate. PMT will be
0.
very good.
0.
So let's jump into the calculator. So first let's do 4% divided by 365. See, we are getting this number right. So what you should do is, instead of writing this particular number, because this is a complicated number, just calculate it here and press I by y. Automatically it gets into I by y. Okay. Now 365 is n. Okay. 0 is PMT and 3 plus minus is PV. Compute FV. See 3.112. 3.122, sorry, whatever. This is the answer which is written here also. 3.122. Can you all see this on the screen?
Yes, sir.
Yes.
So this is how you calculate the future value. Am I clear?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Any questions, anyone? So if you notice something over here, M and N written, 1 plus R by M. What is R? 4%. What is M? 365, right?
Number of period.
Number of periods. But see, what is, why is written M into N? See, try to understand. Here it was a 1 year period. Here it was a 1 year period. Suppose this was quarterly. Let's suppose that interest rate is the same 4%, but it was quarterly. So I would have done what? 4% by 4, right? 1 plus 4% by 4 to the power. How many years? One year, right?
16.
So let's
To fourth.
let's take it is 3 years. Let's assume it is 3 years. So 4 into 3, right? 3 years and 4 quarters in each year.
Yes.
Everyone, are you getting me? So what is this 3?
Yes.
This is N, number of
N.
years. What is this M? Number of periods in a year. Are you getting me?
Yes, sir.
Yes, sir.
What about others? Cheryl?
Yes, sir.
Yes, sir.
Yes, sir. Clear.
Okay. So this is the same thing. Let me just elaborate on this because there is something called E written over here. Suppose they say continuous compounding. That is every minute, every second it is compounding. It's not daily. It's every minute, every second. That is called what? Continuous. So now how to calculate this? Now you cannot calculate this on pen and paper. You need the calculator here. So future value is nothing but what? FV into E. E stands for continuous to the power R into N. Suppose it is 4% and N is 12. So 0.04 into 12. So calculator will automatically understand that your interest rate is 4% for 12 years and it is continuous in nature. So suppose 50,000 is the investment. Interest earned is compounded continuously. It is written continuous. What is the interest rate? 3.6%. What is the period? 3 years. So how will I calculate the future value? It is 50,000 into e to the power 0.036 because it is percentage. So 0.036 into 3. So first calculate. See this. Please look on the screen. Second, clear TVM. CEC. Second, clear TVM. Second, clear work. Please remember that every time you make a fresh calculation, first press second, then press clear TVM, then press second, then press clear work. This just clears everything. Second and clear TVM clears the time value of money calculations. Second and clear work clears the rest of the calculations. So basically it clears everything. It clears the calculator. Basically, if you want to delete someone's memory. So these are the two buttons to clear the memory of BA2 plus. Okay. So coming back to the point, 0.036 into how many years? 3, right? Everyone? 3. Nobody's answering. Am I teaching myself time value of money?
No, sir. No, sir.
So now I got my number for the numerator in the power, basically the power. Now notice where is EX? See here, right above ln. ln means log. So how to get EX of this? I will press second and I'll press this log button. Sorry. See, this is the number of continuous compounding into 55,702 is the number if you compound the 50,000 continuously. Are you getting me? Yes, no, anything? Quickly, please tell me. Everyone, yes or no? Hello.
So can you please repeat it?
Sure. So you understood the logic, right? That it is continuous compounding means what? Every minute, every second, money is growing, right?
Yes.
This is the fastest mode of compounding. Now, how to calculate this? You know that interest rate is what? 0.036, right? How many years? Into 3. Because for 3 years, you will get 3.6%. That means in 3 years, how much will you get? In simple terms, 0.036 into 3. Okay. Because it is compounded continuously, press second.
So
And
can we
press.
do 3.36 into 3? Or do you have to do it?
See, you have to take it in decimal, otherwise the calculator will show incorrect result. Because
Okay.
they understand it in decimals only. So 0.036 into 3. Second e to the power x. This is the factor. This is the factor. So 1 rupees will become 1.114 rupees if you invest it for 3 years on a continuously compounded rate of 3.6. So how much will be 50,000 into 55,702? Are you getting it now? Hello.
Yes. Sir.
Yes, sir.
Sure.
Yes, sir.
Cheryl, is it clear? Sure.
Yes, sir. So after you divide the first part, that is 3.36 divided by 3 years, you then press
I don't divide, I multiply.
yeah, I'm sorry, multiply, and then you press that ln button. Before that, you press the second button, right?
Yeah.
Okay, so, and then multiplied by 50,000.
Yeah, but why do I press second and ln? See, what is written above ln? It is written e to the power x. So it's second in command, right? So I need to
Yes.
press second and then press ln. Because I
Yes.
want the e function, I don't want the ln function. This is a
Right.
calculator jargon or calculator way. So you need to remember this.
Okay.
Whatever is in yellow, if you want to apply that, you need to press second.
Okay, sir.
Okay, everybody, am I clear till here?
Yes.
Sir,
Yes, sir.
I have a doubt.
Yes, sir.
Sir,
Yeah.
this concept of continuous compounding, is it relevant in practical life?
Yes, it is. It is very
Like-
much.
Sir, can you explain its relevance?
As in, if suppose you are investing in some instrument in forex market, where suppose currency, now currency can change every minute, right? So if I ask someone that I want to invest in euros, I want a continuous rate of return, then they will give me a continuous rate of return. They will say, okay, we'll give you a continuous rate of return of 12% or something. So it's possible that you might get a rate, a continuous rate in a particular financial instrument, most probably in a currency, because it's
Okay, sir.
changing every second. Like land, it's not like that, because land is having an appraisal value. It's valued on a very delayed basis. Stocks, currencies can be possible. Commodity can be possible. Okay, am I clear?
Yes, sir.
Yes, sir.
So all good till here, everyone? Are you able to understand everything and
Yes, sir.
feeling confident about the program?
Yes, sir.
Yes, sir.
Such a low tone for the confidence, Kirat. So anyways, so guys, let's take a quick break of around 12 minutes. It's 12 or 15 minutes maximum. It's 6:52. let's start at 7.5. Okay, we'll start at 7.5. So let's be back by 7:05 and then we'll continue the topic. Okay. All right, guys, let's begin again. Let's start the lecture. Everybody, are you back? Kirat, Naman, Prachi, Cheryl, Manmeet, Dilpreet, everyone.
Yes, sir.
Yes, sir.
What about others?
Yes, sir.
Naman, Prachi, where are you guys? Cheryl.
Yes, Samir.
All right. So let's continue. Let's quickly go through this sum. So this will give you a very good clarity on different periods. If you are investing, suppose 100, rate of return is suppose 12%. Okay. What is the future value of this 100 over different time periods? That is, if I'm earning 12% annually, that is each year, suppose the period is 1 year. In 1 year, how many semi-annual periods are there? 2, right? 6 months. Semi-annual means 6 months. Quarterly means 3 months. Monthly means 12 months. Daily means 365. Continuous means e to the power x. So this will be what? 6 months will be what? 2 periods. This will be 4. This is obviously 12. So more the number of periods, higher will be the future value. Do you agree with me on this?
Yes, sir.
Yes, sir.
So here, in this case, n is what? 1. I by y is 12. PV is minus 100. Compute FV. 112. Let's have a look on the calculator. 12 I by y, 1 n 100 plus minus PV 0 PMT. Compute FV. See 112. Getting it, everyone? Now suppose I want you to make this semi-annual. What will I do? I will not erase all this data. I will simply make n will be 2. 2 is n. I by y will be what? 12% divided by 2 because it's semi-annual. So 6 I by y. Compute FV. C 112.36. How did I get this result without putting PV and PMT? See, I did not clear the calculator. I did not press second clear TVM. I just pressed clear work. So to remove whatever was in front of me. So if you don't press second clear TVM, calculator remembers all the past calculation or past codes. So I just rewrote or re-entered the Pn and I by y and I got the result. Similarly, if suppose I want this quarterly, so 12 divide by 4 is what? 3% I by y, and number of periods in a year 4. So n is 4. Compute FV. See 112.55. 112.55. What is the interest rate? 12.55%. 112.55 minus 100 by 100. Are you getting this, everyone? Yes
Sir,
or
did
no?
you press second clear work or did you press just clear work?
I just press clear work.
Okay.
Everyone, are you getting this? Cheryl, Dilpreet, Naman.
Yes, sir.
Yes, sir. Yes, sir. Yes, sir.
Now monthly. In monthly, what we'll do is 12 is n and 1 is I by y. Compute FV. 112.68. So every month my money is getting compounded. So 112.68. 12.68%. Suppose daily now. Daily will be 12 divided by 365 I by y 365 n compute FV. See 112.7475 yani 112.75. Let's round it off. Okay. If you do the continuous calculation, let's see that also. 0.12 second e to the power x. See, how much are you getting? 1.1275 into 100. 112.7497. So this is also coming to 112.75. See, there is a very minute difference. Earlier was suppose 112.7486. This is 112.7497. Technically, both are 112.75, more or less. So that basically means as you increase the frequency, after a point of time, the returns don't increase drastically. They are more or less the same. So if you are calculating daily or continuous, the answers are more or less same. Okay, am I clear, everyone?
Yes.
Is the calculation clear to everyone?
Yes, sir.
Any questions? Anyone, any questions still here? Just one second.
No,
Just okay. Sure, right? No doubts. Can I move ahead?
yes, sir.
Now look at this stated rate and effective rate. Now try to understand. When I say 12% and then I start writing compounded annually, quarterly, semi-annually, monthly, daily, continuous. See, 12% is the rate. This is what? This is the stated rate. I am stating that you will be getting 12%. But what is the effective rate or the actual rate? The actual rate is, in case of annual, 12% only. So here stated and effective rate is same. But what is it for quarterly? 12.55. What is it for semi-annual? 12.36. Monthly 12.64 or whatever, 68. And this is 12.74, 12.75 like this. So if you notice, there is a gradual rise from 12% to 12.75%. But it is increasing at a decreasing rate. This is all logical. I'm not trying to make you memorize anything. From 12, I went to 12.36. So there was a jump of 0.36%. But from 12.36, I increased to only 12.55, 90.19. From 12.55 to 12.68, there is a rise of 0.13. From 68 to 74, only 0.06. So like this, interest rate is rising, but it is increasing at a decreasing rate. So every time I'm investing, my stated rate is the same. The effective rate keeps going up depending upon the periodic cycle, as in how fast it is moving. Okay, am I clear?
Yes, sir.
Everyone? Anyone, any questions? Hello, Kirat, Naman, Manmeet, Prachi, any questions?
No, sir.
No, sir.
Sure, right? Any doubts, guys, please feel free to ask. Don't even think for a second that I have a doubt, but it is too simple to ask or something.
Sir, can you please explain again?
Which part? Prachi, hello.
Sir, how to calculate stated and effective rates?
The stated rate is given. Suppose I am
Okay.
saying that I by Y is 12%, or I am saying that you are earning an interest of 12%. Like this example, annual interest rate is 12%. But if it is written compounded quarterly, then my stated rate is 12%, the rate which is given. But what is the effective rate, or actually how much are you earning? You are earning more than 12%, right? Because in every 3 months, the interest is also getting reinvested. So quarterly it is 12.55%. This is the effective annual rate. Are you getting me? Prachi, hello.
So there's some network issue. So I'm not able to listen.
What about others? Can you all hear me?
Yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
Prachi, then I think you have a network issue at your end. Maybe you need to change the place where you are sitting or something so that the internet is better. Hello, Prachi, can you hear me?
So from my side,
Yeah, Prachi, hello. Hello.
so now it is audible.
Now I am audible. Hello.
Hello?
Yeah, Prachi, can you hear us now?
Yes, sir.
So as I was saying that
Now it is audible.
12% is stated, 12.75 is based on the period, like daily. So if I'm investing money and I'm earning daily returns, actually how much is the return? 12.75. This is called EAR. Stated rate is the rate given to you. The annual rate is technically the stated rate. In case of annually, stated and effective rate is same. In other cases, 12% is the stated rate, but compounding is changing, right? So the effective rate changes. It goes higher than 12. Am I clear, Prachi? Hello. Okay, let's move to the next part. Anyone else, any questions in this? Guys, all of you who can hear me, is this clear?
Yes, sir.
Sir. Yes, sir.
Kirat, Dilpreet, is this clear? Cheryl?
Yes, sir.
Yes, sir, clear.
Yes, sir.
Okay. Now let's come to annuity. So there are two types. Annuity means what? Suppose you invest in a bond. You lend money to government of India and the government says, you give me 100 rupees today and I will give you 10 rupees every year for the next, say 20 years or 30 years. So that means what? It is an annuity. You are getting money for a certain period at a stretch. So suppose you're getting 100, 100, 100, and like this you keep getting for 30 years. Here also suppose 30, but here you're getting. So see, try to understand what is happening. There is something called ordinary annuity and something called annuity due. When I say that I will pay you at the end of each year, that is, this is the day 1st Jan 23. I will pay you at the end of each year. So this is called ordinary annuity. Money being paid at the end of each year is called ordinary annuity. When payment is made at the end of the year or end of the period. Let's keep it period because suppose it is monthly payouts. So it is paid at the end of every month or every quarter, whatever. But if it is annuity due, then payment is made right from the start. That is, I invest the money today and today only I get the first check or first payment of interest. So annuity due is payment at the first day and ordinary annuity is payment at the end of the period. Am I clear in this? Are you clear with this difference of annuity due and ordinary annuity? Everyone, please
Yes.
confirm
Yes,
with a yes
sir.
or a no.
Yes.
Anyone? Cheryl, any questions? Did you understand?
Yes, sir, understood.
What about others? Prachi, can you hear us now?
Yes, sir, just now I joined. There's some network issue from my side.
Okay. Don't worry. Whatever you have missed will be there in the recording.
Okay, sir. Okay.
But please continue to watch the lecture. You can cover the missing part in the recording later.
Okay, sure, sir.
Manmeet, any questions? Kirat?
No, sir,
No,
clear.
sir, everything is clear.
Okay, great. So perpetuity, set of level, never ending sequential cash flows with cost cash flow one period from today. That basically means in simple language, suppose you are investing or lending 1 lakh rupees to me. Okay. You have given me 1 lakh rupees as loan. I am saying that at the end of each year, I will pay you 10,000 rupees. Okay. In perpetuity, till the day you are alive. You live for 100 years, 200 years. If you are Ashwathama, you live forever. Basically, till the day you are alive, you will be paid. But I will never return you the principal. That 1 lakh you are not getting back from me. This is called perpetual payments or in perpetuity, forever. There is no end date. No 30, 40, 50, nothing. Okay. Perpetuity payment is made at the end of the period, not at the beginning of the period. That is at the end of year 1, year 2, or end of the month, or end of the quarter, whatever. Okay, am I clear? So you are clear with annuity and perpetuity?
So in annuity, we just receive periodic payments apart from the lump sum amount, right?
Yes. In annuity, what happens? You get your 1 lakh back over here. Here you are not getting it back.
Okay, sir.
Guys, all good? All clear till here?
Sir.
Yes, sir.
Now, ordinary annuity, let's look at an example. 0.0, day 0, 1, 2, 3. You are getting 100, 100, 100. So ordinary annuity is written with A equals to 1,000. 1,000, 1,000, 1,000. Sorry, investment is 1,000. So 5% of 1,000. 5% of 1,000 is 50. So you get 50, 50, 50, 50, 50 for 5 years. For 5 years, you are getting a sequential payment or a PMT. This is what PMT is. Periodic payments. PMT means periodic payments. So I am getting 50 at the end of each year for the next 5 years. And over here, I get back my 1,000 as well. So how much money do I get at the end of 5 years? 1050. Getting it, everyone? Everyone, are you getting this?
Yes, sir.
Yes, sir.
See the calculator. Second, cleared, TVM, CEC. So 50 is PMT, 1,000 is FV, 5 is N, 5 is I by Y, Pute, PV. See, this gives me the present value. So today, the value of the money that I've invested is, that means today if I invest 1010 at a 5% for 5 years with a periodic payment of 50, I will get, I need to invest 1010 today to get 50 periodically and 1,000 at the end of the year. So the rate of return will be 5%. Okay, am I clear, everyone? So this is PMT, the periodic money that I'm getting as interest. This is the repayment of my loan. And basically, this is the period, number of years. This will get clearer as we move ahead in the upcoming slides. Am I clear, everyone? Yes, no, anything?
Yes, sir.
Yes, sir.
Here, ordinary annuities, now they're writing the opposite formula. You are getting 1,000, 1,000, suppose, 1,000, 1,000. So what is happening here is, this 1,000 is growing. So if you are investing 1000 here, or your annuity is 1000. What is the value of 1000 after how many years? 1, 2, 3, 4. Basically, they are saying that your PMT, suppose PMT is 1000. Now, if PMT is 1000, I am getting 1000 at the end of each year. Interest rate is 5%. That means what? 1000 is growing by 5% each year, right? Everyone, yes or no? My PMT is 1000. I am getting a payment of 1000 from ICICI Mutual Fund at the end of each year. So at the end of 5th year, what is the value of all those thousands? 1000 will become how much? 1000 into 1.05 to the power 4, this one. Do you agree with me on this? Because 1 year has passed and I got 1000. So it will grow for 4 years at the rate of 5%. Everyone, are you getting this? Hello?
Yes, sir.
Yes, sir.
So
Cheryl?
are you reinvesting the first
Yes,
PMT
that is
amount?
what I'm saying. See, first PV. Let's go step by step. 1000, 1000, 1000, 0, 1, 2, 3, 4, 5. I by Y 5%, N 5. This is ordinary annuity. I am asking you to calculate the present value. I want the value of all my investments today. How will you do it? You will either follow the long process, that is 1000 divide by 1.05, 1000 divide by 1.05 square, 1000 divide by 1.05 cube, and it will take you ages to do like this. But this is the basic logic, right? This will tell you the value of all your money, right? Here it is 5 years back. What is PV? PV 0. Value of this entire money today. If today I want to invest money, or if today I want to know the value of this money which I will get in the future, how will I calculate it? I will divide each payout that I will receive by the interest rate for the respective period, right? Everyone? Yes or no?
Yes, sir.
Yes.
Anyone, any questions in this part? Please be clear. Cheryl, Kirat, Prachi,
Yes,
any
sir. So we
questions?
are trying to identify what the PV is for each PMT receivable
Yes.
at the end of the year.
Yes, because we want to know the present value of all the money that we'll receive.
Okay, so sir, will we do it individually and then sum up the amount, or
We'll
is
use the
there a difference?
calci.
Okay.
Second, clear TVM, CC. See, 1000 PMT, 5 N, 5 I by Y, 0 FV. Why 0 FV? Because I'm just receiving PMT. At the end of every year, I'm getting a PMT. So compute PV. See, 4545. Technically, value of this 5000 which I'm receiving in the future, as of today, is $4545. Am I clear now, everyone?
So why did you keep FV as 0?
Why did I keep FV as 0? Because there is no separate payment over here. End of every year, I am getting 1000. But apart from that, I'm not getting anything else.
Okay, sir.
Am I clear, everyone?
Yes, sir.
So why are we doing this? See, suppose you plan to invest. Suppose you plan to invest for 5 years, okay? So two options are there for you. I say that either you give me 4000 and I will pay you 4500 today, or either you invest, or let's change this example once again. Basically, either you can invest the money, suppose you plan to invest $5,000. So option A is you get a payout of say 1000, 1000, 1000, 1,000 like this, you get a payout for suppose 8 years. And another option is you get a payout of 800 for 5 years. So then you calculate both the values and check which is a higher value. Are you getting me? So whichever is the higher value is the option, right option for you. Suppose I'm giving you two plans. Either take 1,000 at the end of each year for the next 5 years, or don't take anything for first 2 years. That is 1 and 2 is 0. From year 3, 4 and 5, take 1,200, or take, how many years have you missed? 1,000, right? So let's make this. So we are lacking by 2,000. So let's make this 2,000. Let's make this 2,000, and let's make this 1,000. So obviously, which option will you choose? Can anyone tell me? Option 1 and 2. Which option will you prefer? Do you want 1,000 rupees at the end of each year, or do you don't want any money for the first 2 years, but then you want 2,000, 2,000 and 1,000?
1,000 rupees at the end of each period.
Because you are getting paid early, right? Why do you want money faster? Because present value will be higher. Present value today will be higher. If you calculate the present value of both of them at 5%, you will get a higher present value over here. Because the cash flow is faster. Am I clear, everyone?
Yes, sir.
Yes, sir.
Any questions? Hello, any questions?
No, sir.
What about others? Cheryl, are you able to understand?
Yes, sir. Understood.
Yes, sir.
And Dilpreet and Kirat?
Yes, sir.
Clear, sir.
Okay, great. See this? Ordinary annuity, PMT is 1,000. I by Y, N. N, I by Y, PMT. PV 0. They are saying that compute the future value. You are just, suppose you are investing money. You are doing an SIP. End of every year, you are investing 1,000. Today, you are not giving anything. Today, you are not giving anything. This money you are giving at the end of every month, suppose. And you're doing this for 5 months. So what is the value of this after 5 months? So that is the future value. So if you take your calculator, second clear TBM, second clear work, 1,000 plus minus. Why? Because I'm investing money, outflow, PMT. 5 N. What is the I by Y? 5. 0 PV. Compute FV. 5801. I invested 5,000, but I will get how much? 5801. Because I am putting in 1,000 every month and I want to know the future value. See, this number is positive. Why? Because I put PMT negative. If I had made PMT, suppose instead of this, I make 1,000 as PMT now. Compute FV. See, this is negative. Why? Because the calculator thinks now that you have borrowed 1,000 or you have received 1,000 and now you want to know the future value. So if you have borrowed money, what do you need to repay, right? So at 5% interest, how much do you need to repay? You need to repay 5801. So always remember, if it is investment, whatever money you are putting in is negative. Whatever money you are receiving is positive. So if you're putting PMT, put it negative. If you are borrowing money, PMT will be positive. This is logical, you don't need to memorize. Am I clear? Yes, no?
Yes, sir.
Yes, sir.
What about others?
Yes, sir.
Yes, sir.
Great. Thank you, Kirat. So-
So I had a question. So in case of, different amounts of PMT, like you showed in the second example where third and fourth year we receive 2,000 and then fifth year we get 1,000.
Yeah,
So how would
unequal
that
cash
be
flows.
some?
I'll
Yes,
teach
sir.
that. Don't worry.
Okay.
That will come at the very end of the subject.
Okay, sir.
There is a different trick in the calculator for doing that. I'll show that. So first let's complete the main part and then we'll come to that. That is a very small change in the calci and you'll understand. So practice question. Haley deposits 24,000 at the end of every year. Account earns 12%. How much money will she have at the end of 15 years? Simple. I'm doing it quickly. You can review it later. If I by Y is 12%, everything is given. At the end of every year, so PMT, 24,000. Present value is 0. Compute FV. Okay. Am I clear, everyone?
Yes, sir.
Yes, sir.
Yes, sir.
Now this question, see, there is a factor given over here. Future value annuity factor. So if today I'm putting in 1,20,000 and my factor is 21.664, that means what? 1,20,000 into 21.664 is the value after whatever number of years. So this will become 25,99,680. Basically, if I'm investing 1 lakh at the end of every year, or I am getting 1 lakh at the end of every year, suppose, what is the future value of that? 1,20,000. It is 25,99,000. How did I get this? See, clearly they have given the future value annuity factor. So they already gave me the factor. I don't need to do anything. Simply multiply it with the factor. They have already calculated the factor for you. They're saying that 1 rupees will become 21 rupees 66.664 if you stay invested for a X number of period. So what is the question? Which of the following is least likely useful? Annuity worth, I need 1,20,000. Future value annuity factor, I need that. So interest rate is not required because I don't need to use the calci. I know the factor. I know the present value. Simply multiply and I will get the future value. Am I clear?
Yes, sir.
Yes.
Yes, sir.
Any questions, anyone? Anyone, any questions?
No, sir.
No,
What
sir.
about others?
No, sir.
All good till here, right?
Yes, sir.
Yes, sir.
See, unequal cash flows. See, now try to understand this. What is the future value? See, future value cannot be done with the help of calculator when it comes to unequal cash flows, because there is no option in the calculator to calculate future value with unequal cash flows. Present value can be calculated. So we'll discuss present value calculation at the end. Future value calculation is the same mechanical way. In exam, they don't ask this kind of question. They don't want you to waste your time. Simply push it forward 1000 into say 1.05 to the power of how many years? 4 years. 2000 into 1.05 to the power 3 years. And like that, you calculate the number and get the total. Okay, I am clear. Am I clear? In future value calculation, in case of unequal cash flows, calculator is not giving us the option. Present value can be done. I will show you at the end. Is future value clear to you in case of unequal cash flows? Everyone?
Yes, sir.
Cheryl, Naman?
So it has to
Yes,
be
sir.
done
Clear.
manually for every PMT, right?
Yes. In case of
Okay.
unequal cash flows, future value.
Okay, sir.
Now there is a function in the calculator. Let me show this to you. Second clear TVM, second CC. Suppose we are doing this only. 1000. Sorry. 1.05. Now what do you want to do? To the power 4, right? To the power 4, right? So see this button, y to the power x. Everyone. Y to the power x, press y to the power x, press 4. See, you got the factor. Okay, everyone. This is how you do to the power in the calculator.
Yes, sir.
into what? 1000, right?
Yes, sir.
So this is the value at the end of 5 years. Am I clear? For 1000 PMT, the first one, what is the value at the end of 5 years? 1215 point whatever. Did you understand this?
Yes, sir.
What about others?
Yes, sir.
So can you repeat,
Yes,
please?
sir.
See this. What do I want to calculate? 1000 into 1.05 to the power 4, right?
Yes.
So 1.05. Now what? To the power. See this button, y to the power x.
Yes.
Press this. Press 4.
4
So
equal
it
to
becomes 1.2155 into 1000. Getting it?
Yes, sir. Got it. Thank you.
Now one more trick. 1 second. One more trick. 1000. Suppose I want to add 5 numbers. Okay. I want to add 5 numbers. I'm not doing this. You understood this calculation. You can do on your own. 1000. Suppose I want to add 15152 and 1 second. Let me take another example. This is an interesting trick. Let me just show. Suppose I write 15152 plus 10,000 into 1.05 to the power 4 plus 2000 into 1.04 to the power 5. Now, one way to do is calculate all the 3 numbers, write those numbers, and then add them. The shorter or the smarter way to do is, in the calculator, there is a store function. That is, you can save the calculation. So let's do 15152. We already know this number, right? So I will press this button. See this button, everyone on the screen. STO. STO stands for store. That means save. So I will press STO. I will press 1. See, this number is saved in the button 1. See, from 1 to 9, you can save total 9 numbers and add them or multiply them or divide them, whatever, with each other. So I pressed STO1. Now what do I do? 10,000 or 1.05 y to the power x 4 into 10,000. This is whatever number. I will make this as. Can you all hear me, everyone?
Yes, sir.
Yes.
Okay. So I'll make this as store 2. So it is saved in the second button. Am I clear?
Yes, sir.
Yes, sir.
Now 1.04 y to the power x 5 into 2000 store 3. Now what will I do? Store 3. Okay. Store 1. Something is stuck in here. One second, the calculator is hanged a bit. I don't know why. Can you all hear me? Is this audio clear or is it hanging?
No, sir. You're
No,
clear.
sir. Or
Audio is fine, sir.
All good? Okay. Store 1 plus store 2 plus store 3. 1 second. I need to redo it. Something has got deleted, I think. So I take suppose 1, store 1, 2, store 2, 3, store 3. So store 1 plus 1 plus store 2 plus store 3. Some error is here in this. It usually does not happen. Just let me check once. I think the calculator is getting hanged. Let me just give me a moment. 10, store 1, 20, store 2, 30, store 3. So now 1 plus store 2. There is some error. I will check this and I will confirm this in the next class because this calculator is getting hanged, I think, today. It maybe because it's on for a really long time and it's an app. So sometimes this glitch happens. I will just reboot it or maybe delete it and download it again and show this. This is not an important feature, so don't worry about this. Point was to show you how to add all the 3 numbers. Okay, am I clear till here? Hello, everyone. Yes, no, anything?
Yes.
Yes, sir.
So I'll show that feature tomorrow. I'll just check what's the error with the calculator. It's getting hanged in this function. Sometimes this happens. Not to worry. It will not happen in your calculator. This is a computer-based calculator. This is not a actual calculator. The actual calculator looks something like this. So I'll show it to you in this calculator tomorrow. So coming back to the discussion. Okay, am I clear till here, everyone?
Yes, sir.
So finding the present value of a single cash flow. This is nothing but you're calculating the PV of a single cash flow. So we have already covered this. I want to know the value of 100, or I want to know the present value of 110. 1 second. There is some glitch happening. I don't know what. That is why this error is occurring. Okay. So this is 110. You want this to calculate the present value. So what is the present value of a single sum? How much is 110 today if I discount it back by 10%? So we have done this multiple times. Now point what I want to discuss here is that there are 2 points written here. For a given discount rate, see, listen to this carefully. For a given discount rate, the farther, that is the more far in the future, the amount to be received, the small the amount's present value. That means the later you pay me, the present value will be lesser. Remember, if I am calculating one second. So The later you pay me, if I'm paid 1,000 versus 1,000, 1,000. The later I'm paid, the present value will be lower because it will be discounted for a longer period, right? Here I will discount this 1,000 for 3 years. This will be discounted only for 1 year. This will be discounted only for 2 years. So obviously this will have a lower present value. Do you agree with me, everyone? Yes, no?
Yes, sir.
What about others?
Yes, sir.
Cheryl,
Yes, sir.
please confirm. What about others? So guys,
Yes,
it's the
sir.
first class, so I'm going slow, but this is a very slow pace. So please, I am just because it is the first day and I want to build the momentum. So I'm trying to keep it slow and trying to cover as slow as possible so that the base is strong. I hope there are no queries, right?
Yes, sir.
We're in the last 8 minutes of the class for today. So that is why I'm asking. Any questions till now in any portion? Yes, no, anything?
No, sir.
What about you, Kirat, Cheryl? Are you able to understand everything?
Yes, sir.
Okay. So holding time constant, that is if I don't consider time, the larger the discount rate, the smaller the present value. Obviously, if I'm keeping the time constant, that is from end of year 1, both of us are getting 1,000. But my discount rate is what? 8%. Your is 5%. That means what? My present value will be lower. Yours will be higher because I am getting a higher rate of interest. So I'm discounting it back by a higher rate of interest. So I need to invest less today to earn more in the future because interest rate is high. You need to invest more today to earn the same amount in the future because your interest rate is low. Am I clear? Yes, no? Everyone, please be motivated. It is the last session. It is the last 5 minutes of the class for today.
Yes, sir.
Yes, sir.
What about others?
Yes, sir.
Cheryl, any questions?
No, sir.
Okay, so last 5 minutes, I will not teach anything new, just a brief discussion for the classes going forward. The batch has started. We have started with quants. If any of your friends who have not yet joined but are planning to join, strongly suggest them to start immediately so that they are in pace with the class. Don't wait for the last moment to start a course. It's a very bad approach and you will lose money both in the course registration as well as in because you lose time. You will get the classes obviously even if you don't pass, but why to do such a thing? Because your exam fees will be wasted. So if you have not yet joined but you're planning to join, please join immediately so that you are with the class immediately. We are at the right pace. We have started on time. We have enough time to cover the entire curriculum and do the revision sessions as well. Second thing is follow my notes and also the material which VG has shared with you, VG ID has shared with you. If you have not yet registered, then once you register, they will share it. Third, buy the CFA calculator. Don't wait any longer. You need it with you in handy so that you can practice with me. When I am solving, you are also able to push the buttons and solve them. That will give you confidence. Fourth, read the material thoroughly. Don't waste time that, okay, I'll study after a month. Let me relax. Let me attend the lectures only right now. You will lose track. Right now, you won't feel the pressure. After 1 month, you will start feeling the pressure because if you don't study, if you study, then nothing like it. So any questions, guys, from
So,
lecture standpoint or anything?
which month are we targeting the examination?
August.
Okay. And so the notes that you're sharing, like, do we have Schwezer notes or are these personalized notes from your end?
These are my personalized notes. You can also buy the Squeezer material. I think you will be given that. So you will have the Squeezer material, but these are my notes. This is right from the CFA curriculum. So what happens is students don't get the time to study CFA curriculum. It's like the Bear Law, Bear Act, in as you call it in CA terms. So I cover it right from the institute material so that you know the overall syllabus in detail. Plus, you also refer the Squeezer material so that you are able to, you know, go through that and get a hold of the subject. So with the help of both, you practice questions and then you are sorted. You don't need any third-party material apart from my notes and the material which you are getting.
So, sir, you're using the institute material as a reference while you're teaching us?
Yes, I create my notes from institute material and from various other sources. So these are my self-created notes. This is not a part of any other book or something, but the reference is from the CFA Institute so that there is no ambiguity.
Okay. So, do we have chapter-wise question banks and mocks?
Yes, it's in the CFA. Once you register for the exam, you get access to everything. Apart from that, VGLD is also giving you the access on their LMS where you can practice questions.
Okay, sir. So, how
So
long will you take to complete the portion? Like, how much time will we have to self-study?
see, along with the class, you should invest 300 hours. So 150 hours class, 150 hours from your side. That is the expectation. If you do that, and this is the minimum. If you put in more, it is great. So you will definitely clear. Usually people study 2 hours a day along with the class. And then right before the exam, they take some pressure and study long hours and sit for the exam. Last 1 month, you take a bit of pressure. Before that, study 2-3 hours a day and attend the lectures, then it's enough.
Okay. So, how much do we have to memorize, or is there any
No
formula?
memorization.
Okay.
CFA beauty is that MCQs are there. Once you start studying and solving questions, you will realize that the best part of this course is that you don't need to memorize.
So, not even the
Classes will be
formula?
on one second. Just classes will be on weekends. Yes, please tell me, Cheryl.
Yes, so sorry, sir. I mean, so the formula we'll have to memorize, right? Some of the
Formulas, if you
parameters.
understand, you don't need to memorize. Like FVPV, do you need to memorize now? You already know how to you calculate that in the calculator.
Right, sir.
So once you practice questions, it's in your blood, it's in your system. Then you don't need to technically memorize anything. So practice is just what is needed. Practice, practice, and practice more questions. That is the only way to clear CFA. There is no other trick. I will tell you many more cheat codes and shortcuts once we get going. Since this is just the first day, we are in the intro kind of a stage and we have just started with the lecture. So we have not discussed all that. Once students have formally started the lectures for say another few classes goes by, you are into the flow of the course, then automatically with the passing time, I will tell you everything, which will help you in clearing the exam. So don't worry at all. I am there till the end. I will take all the lectures, I will take the revisions, and I will solve your queries. So my hand holding will be there. You will not have any problem from that point of view. You just need to put in your effort to clear the exam and start ASAP. Don't delay now because your early bird window is also going to end on 31st January. So you will save $300 if you complete the paperwork by 31st January. So today is 28th. So I think you still have 3-4 days. You can register after that as well. It is just that the early bird will end. So it's better that you start immediately and register. Once you enter now, once you start the process, once you get going, then everything starts falling in place. Till the point you don't get going, you are always confused. So for now, level 1 and level 3, 1st February is the last date. Okay. On 1st February, so US and India time gap is there. So I would suggest you, this is as per US time zone. So please, I would suggest do it ASAP. Don't wait for the last day. So what happens is sometimes credit card is not working, net banking is not working, payment did not went through. All that happens and then people get worried. So best is you have a Sunday tomorrow also. Tomorrow is 29th. Just complete all these formalities and get ready for the exam. and register with the VGLD also if you have not yet registered. Some of you have already registered. So for those people, I'm not saying this. So am I clear, guys? This is all from my side for today. Any questions from your end?
Sir, sir, I am preparing for November attempt. So, like अभी से ही coaching लूँ या बाद में?
ले लो आप, material change नहीं होगा. Same syllabus. You'll be prepared faster.
So are there any changes with the curriculum for 2023?
2020 from 2022 it has changed in 2023, but in 2023 there are no changes. Like whenever a change comes, it comes in the new year and it
Okay.
stays applicable for the entire year. Like in 2023, whatever changes have been made is incorporated in my notes. So for this year, whether you give in August or November or whenever, same notes app is applicable. If you give it in next year, then some changes happen, but that is also very minor. Nothing major.
So will there be study tracker provided to track our progress, or to track how much time we need to invest in any subject?
I will give you an estimate of that as well. Don't worry. I will give you an estimate for that.
Okay, sir.
Anything else?
Sir,
Yeah.
sir, for registration, do we require a passport?
Yes, you need a passport.
Okay, sir.
You don't have a passport yet, Dilpreet?
No, sir.
Sir, I
So,
don't have.
So if you don't have a passport, the best thing is apply for a passport and give it in November and start the tuitions now. And for people who have a passport, give it in August.
Okay.
Yes.
You can also give it in August, by the way. Okay, it is just the early registration charge. It's not like you cannot register. Passport can be done in 2 weeks' time. So register, get that passport done, and then apply for August only. Why wait for 6 months? It's a trade-off. It's totally your decision. You want to save $300 or you want to save 6 months? But the course is applicable for both August and November. Whether you sit in August or November, the notes are the same. So there is no doubt in that. Okay, am I clear?
Yes, sir.
So for
So
CFA registration, we have to use only credit card, or there are other payment options?
You have to check. Honestly, this is an operational query, so I am not the right person. You can talk to the VGLD team. They will guide you. They know all of this.
Okay, sir.
So if you don't have credit card, they will help you with it. They will provide you some source of payment. You can pay them and they will pay on your behalf. All that can be done. That is a minor issue. You can just talk to VGLD team and they will help you.
Okay, sir.
If someone is not able to pay at once, there is loan facility available. VG can help you with that as well.
All right. So this batch will wind up by May.
Yeah, kind of April, maybe April. Yeah, April.
Okay, sir. And so then followed by that, we'll have to self-study, or there will be guidance?
I will
around
be
this?
there to guide you. Obviously, it's self-study, but there will be some revision sessions and doubt clearing sessions can be also conducted. All that can be done.
Okay, sir.
And I am always there on WhatsApp. My response time is 24 to 48 hours. So within 24 to maximum 48 hours, your queries will be resolved.
Okay, sir.
Any other question, anyone?
So all subjects are taught by you only?
Yes,
Okay.
I will teach all the subjects. I teach all the subjects. So you'll not face any queries. If you have any, I'm a one-point contact, so it's easier for you. You don't need to talk to 5 people and feel confused that for portfolio I'm talking to A and for derivatives I'm talking to B. So all that will not happen. I will answer all the queries.
So for derivatives, you will teach from basics, right? The financial
Yeah.
statements
See,
and
level
all
1
that.
is all basics. So
Yes,
don't
sir.
worry. Anything else, anyone? Yes, no, anything, guys? Any other
Sir-
questions? Yeah. Hello.
Sir, nothing,
Hello.
nothing. By mistake.
Okay. What about others? Manmeet, Kirat, I'll end the session. Just confirm if it's clear, if any questions are there.
Yes,
So that
sir.
because
Yes, sir.
Okay.
Everything is clear.
were you able
Yes,
to
sir, all
understand
clear.
today's topic?
Yes, sir.
Yes, sir.
Yes, yes,
I hope all the concepts were clear. No questions, right?
No, sir.
No, sir.
Cheryl,
Yes, sir. Clear, sir.
okay. Dilpreet, you were able to understand everything?
Sir.
Okay. Thank you, guys. Enjoy your weekend. See you tomorrow at 5 o'clock.